Welcome to this week's episode of the Monocle Banking Podcast, curated by Monocle Solutions. Whether you're a financial professional, an enthusiast, or someone who just simply wants to stay informed about the world of finance, you've certainly come to the right place. Now, last week, Gibbs hosted its annual Beyond Banking conference, and one of the hot topics, certainly a topic that got delegates hot under the collar, was the issue of the European Union's Carbon Border Adjustment Mechanism, the CBAM as it's become known. Many are arguing that it smacks of hypocrisy and it just looks like green protectionism. Now, recently, our own Reserve Bank issued a paper titled Carbon Taxation in South Africa and the Risks of Carbon Border Adjustment Mechanisms, which raises some important questions for banks and for the broader economy and business. Well, my guest this week is an expert in the field, having founded Cova Advisory. He then sold that business to EY a few years ago and is now a partner at the firm. His specific focus is on tax sustainability issues locally and globally. He's a respected business consultant. He's got expertise in the fields of government grants and customs and excise and incentives, as I said. Prior to founding Cova Advisory, he was a tax partner at one of the big four firms for 12 years when he set up and led the Sustainability and Climate Change Division and served on the global exco of the sustainability practice from its inception back in 2009. He was until recently a board member at the South African Institute of Taxation site, and he's held numerous leadership positions, including chairman of the Incentives Association, chairman of the Trade Committee at the South African Chamber of Commerce, chairman of the Business Environment Committee of the American Chamber of Commerce, and executive committee member of Euro Chamber, and he's also served as a board member responsible for sustainability at the American Chamber of Commerce. Duane Newman, welcome to the show. Great to have you on the podcast.
Yeah, great to be here, Michael.
It's quite a CV. And when you look back on it, it's just amazing, Duane, isn't it, how this field of sustainability has evolved, of incentivizing the right kind of behavior. Just tell us a little bit more about your attraction to this specialized field and profession.
That's a really interesting question, Michael. So, I started once I qualified as a chartered accountant in 1994, and we all know 1994 was a watershed year for South Africa. So we were obviously reopening the economy. So I got really attracted to economists, and I often call myself an amateur economist. But obviously over the years, working with some of the most respected economists in South Africa, from Mike Schisler, Tony Twine, and even working in practice, professional practice, with guys like Roy Haverman, Kay Walsh. And obviously they got my interest peaked in obviously looking forward and how economies, industrial policy impact the success of economies. And then the climate change debate started to heat up. And we obviously thought way back in 2008, 2009, it probably would have been accelerating quicker than it currently is. And I remember going to my first COP meeting, I think it was COP 15 back in Copenhagen, where it obviously, got the globe's attention. And just really understanding that, these policy instruments, climate change was a real thing and governments were going to have to do something about it. And I was spending most of my time advising clients on these carrots and sticks. So the carrots being incentives, and the sticks being some kind of tax. And we're starting to see those unfold. So I remember National Treasury put out an environmental tax policy document way back, 2008, working, what should South Africa do? And that took us 10 years to design a carbon tax, because that really seemed to be the simpler of the two instruments. So you had two main options. Either you implement a carbon tax where government sets the price, or you put in what they call a cap and trade, fundamentally an incentive system, where the market sets the price on what carbon should be priced at. So it's been really interesting watching all those developments. Probably back in 2008, 2009, I was seen as a tree hugger. And I think back to your opening comment now, you can see now banks are getting involved. And I think that's now and getting hot under the collar around climate change and climate finance, which effectively means these issues are getting mainstreamed locally and globally.
Yeah, and in the European Union, for example, they are debating capital charges, whether or not banks should be charged a specific rate depending on the intensity of their lending, their carbon intensity of their lending. So regulators are definitely getting involved, to your earlier point, debating whether the carrot or the stick is appropriate to start to drive the change that we know is this big, hairy, audacious goal that the world had set itself through the various COPs to get to net zero by 2050. Coming back, and I've just got to mention, COP28 hosted in Dubai in the UAE, seem to be hijacked to some extent by some of the vested interests that want to maintain the status quo. But that's an aside. Coming back to South Africa's carbon tax framework, we're currently at, 190 Rand per tonne of CO2 equivalent. Can you just provide us an overview of our carbon taxation framework and that historical development, which you did touch on briefly in your introduction?
Yeah, so I think, South Africa did have to think about how we were going to, change behavior. We're fundamentally a carbon-intensive economy, mainly driven by our use of Eskom power as an economy, and the economy was based on that coal being cheap, and you fundamentally built a very carbon-intensive economy. So the government thought about a incentive program or a carbon tax. They fundamentally thought, okay, well, a carbon tax is easier to implement. Okay, that was fundamentally the logic. Okay, you can bring predictability to the price because you can give the market medium to long-term price signals on where the carbon tax price would be going. So it started out at 120 Rand a tonne. In 2019, it was implemented. Now, as you say, we're sitting at 190 Rand a tonne, and with clear predictions of where the price will be at 2030 and beyond, which I think is really useful. I think the challenge we've had with the implement of carbon tax is because you're paying carbon tax on what we call Scope 1 emissions. So Scope 1 emissions are if you had to put a bowl over your own operations as a business, what are all the emissions that your business gives off? So through fuel combustion, generators and the like, process emissions, so you're manufacturing cement or steel, and you obviously give off emissions in those processes. And then the last one is fugitive emissions. So if you're mining for coal and giving off emissions, it's like nearly by accident, as I'd call them. So you've got this complex calculation process where you have to calculate your Scope 1 emissions. But obviously to ease in this carbon tax, and obviously there's been lots of arguments in the public domain around 120 Rand a tonne. That gets lost in the rounding. If you look at what carbon prices are in other developed countries, so like in Europe, probably 80 euro a tonne, and in some other jurisdictions even higher than that. And then to obviously ease in the carbon tax, we gave like what we call basic allowance, so 60 to 70% basic allowance. So that effectively is like a free allowance where you're not paying carbon tax in the first 60% of your emissions. So that effectively, with all the other allowances that were available, bringing the effective rate down to 6 or 7 Rand a tonne, which is like pretty 10% of what it should have been. So the question is it high enough? And that is now starting to pop up as a real issue when you start looking at things like CBAM, because the effective tax rate in Europe is going to be much higher. So even though you would get credit for the carbon tax you'd pay in South Africa, and some of the modeling we've done is that it literally gets lost in the rounding on some of the really carbon intensive export and trade exposed sectors.
And the question to that point is how that low effective carbon price then impacts our global competitiveness. And clearly the environmental impact is that there is very little incentive to decarbonize, but in the light of CBAM, it clearly will have an impact on our competitiveness. So let's just understand and unpack CBAM a little bit. I was amazed. There were a couple of bankers in the room who had never heard of CBAM. And someone approached me and said, Michael, it's the first time I've heard of the CBAM acronym. Can you tell me a little bit more about it? I was like, where have you been?
You've been? Yeah.
No. So tell me a little bit more about, what exactly is the EU CBAM? How does it function?
So one step above that, so obviously the European Union has been obviously thinking carefully around how they accelerate their decarbonisation. So they've got the EU Green Deal, and they've obviously put a range of mechanisms in place, from regulations, reporting, and obviously a tax is one of those areas where they're saying, okay, we as Europe have had a cap and trade system, the EU emission trading scheme, for quite a few years now. So we've effectively been penalising our local manufacturers by levying fundamentally a domestic excise tax on highly emitting producers in Europe to force them to decarbonise. Okay? Yes, were they giving lots of incentives along that journey? The answer is yes. But now they're saying, well, we've gone on this decarbonisation journey. We forced our local manufacturers to decarbonise. But what about all the other countries outside Europe who are importing into our market where they have not implemented a local carbon tax like South Africa, saying, well, that's unfair. So the whole idea is saying, well, there's now a concept called carbon leakage. So effectively, in the worst case scenario, you then move your factory outside Europe and then import your goods into Europe and not pay a tax. So fundamentally, that's what the Europeans are trying to do. They're trying to level the playing field, saying, well, we've got a local carbon regime where we're levying penalties on our local manufacturers. Now we want to do the same to stop carbon leakage and fundamentally put a carbon tax on imported goods into Europe. What they have also said is that, so in terms of the EU trading scheme, they've got what they call free allowances. So for some industries, it's really hard to decarbonize. So cement, so that sometimes the only way to decarbonize is actually switch your factory off. Yeah. So they gave these free allowances to ease the pain, a bit like South Africa's done with our basic allowances and carbon tax. So what they've done is implemented a CBAM in the first reporting period. Was in October last year, and they've split it into two main phases. Phase one is what they call the transitional phase. So effectively getting everybody used to collecting their greenhouse gas and carbon data, working out what's their embedded emissions in the product they're exporting to Europe. So up to the end of 2025. So you're going to report, and it's going to get more and more accurate. So initially it was just default factors, emission factors. And then now from July this year, you're going to have to report your actual embedded emissions in your product. And then from 2026, they're going to start levying this CBAM, which is linked to effectively the carbon rate in Europe under the EU ETS, which is say €80 a ton. But it will start out at 2.5% of that. I think it's up to 2034. It will be phased in. Okay. At the same time, they're phasing in the carbon tax or the CBAM into Europe. They'll be phasing out these so-called free allowances in Europe. So currently, in some sectors, they're seeing at 100%. So by the same time, 2034, all those free allowances will also be phased out. So it should be level playing fields.
Okay. I just want to understand on that point, Duane. So you're saying €80 a ton or dollars a ton? Euros a ton. Okay. So times it by 20.
Euros.
Yeah. It's 1,600 Rand on a ton. But currently we're only at what, 2.5% of that, you said?
So currently we're at zero. Okay. So currently you're only reporting. So from 2026, you're going to be 2.5% of that €80 ton. Okay, so and it'll be phased in. So it'll be 2.5% of the €80, then 5%, then 10%. So by 2028, you'll be sitting at €8 a ton.
Wow.
Okay, and then all the way up to €80 a ton by 2034. Okay, wow. So again, it's clear what the price trajectory is on your product. Now, we're obviously sitting here in 2024. And some companies are saying, well, I'm not paying a CBAM now. So but currently, where are you getting your power from? How carbon intensive is your business? How trade exposed are you to Europe? You need to understand the price of those emissions in your product. And in some products, it will go up to, say, 40 or 50% of the current selling price of that product, which will make you uncompetitive in that market. So you're going to have to do something about it.
How much consideration is given to country-by-country basis and the fact that certain countries developed off the back of an endowment of fossil fuels at a time when the world didn't discourage extraction of fossil fuels and so has developed a very carbon-intensive economy, such as South Africa's? And I know we're, in terms of our share of global greenhouse gas emissions, I mean, we're around 1% or thereabout. But obviously one of the most, if you look at it a per capita basis, one of the most carbon-intense, just because the bulk of our energy still comes from coal-fired power stations. How much leeway is there to give South Africa a bit more time to transition? Because I can't see, I mean, if you're a business, if you're looking for alternative sources of supply, there aren't that many from the monopoly. I know the energy sector is changing, but not changing fast enough to be able to comply with some of the CBAM timelines.
That's a good question. So I think we've heard quite a lot of, I suppose, debate in the public arena around how World Trade Organization friendly is CBAM. And the argument the EU government is putting forward, saying, well, all we are doing is leveling the playing fields. Currently, local manufacturers are subject to effectively a carbon price, and we're going to be levying the same tax on importers. Okay, so it should be the same. So that's the justification. Then in terms of what they call most favored nation principles, they're saying, well, we can't differentiate. So if you remember in terms of normal like trade agreements, so trade agreements are allowed if you cover substantially all trade, when you got sort of trade agreements of phasing duties down. But the maximum duty rate you can levy is what they call a most favored nation duty rate. So that they're saying as well, we can't, if you're going to undermine and have different rates for different countries, we're going to promote carbon leakage, which is what we're trying to stop in the first place. And because we're giving you such long price signals of what the carbon price is going to be, we expect countries to be accelerating the decarbonisation. Now, there is lots of support, okay, putting back to the climate finance topic, right? And that's obviously where the banks are getting involved in this. So is there lots of promised financial support in the form of lower interest finance, grants from developed countries to developing and least developed countries? The answer is yes. Is it at the scale it should be? The answer is no. So I think there is a flow of funds, okay, from the developed countries to the developing countries. And I think it is getting really, really complex to navigate. So I think that's probably the challenge I think a lot of businesses, okay, in developing countries will face. Saying, well, how do I get my hands on all this cheaper green money? How do I make sure that I leverage off the incentives that the Europeans are giving? And the challenge is it's really, really hard to do.
Yeah, on that point, Duane Patel was on one of the panels at this conference last week, and I pushed him on where the $8.5 billion of the Jet IP, when are we going to start to see some of the funds flow? Because so far, he admitted that we've only really seen funds flow to help with a budget framework and, very small amounts. I mean, very trivial amounts in the broader scheme of things in order to help South Africa move. So I guess that's where one gets a sense of, yes, one can understand if you're a local manufacturer in Europe to have to compete when you've got to incorporate this tax into your cost of production against imports, which don't have to incorporate this tax. You feel like there's an unfair playing field. But developing countries can also say, well, Europe, you've already developed on the back of fossil fuels. And now you're telling us we can't develop on the back of these significantly cheaper to extract and produce energy with fossil fuels. So you then got to come up with some kind of alternative, which is the funding. But the funding isn't arriving.
I mean, I suppose since I've been involved in, climate finance, carbon credits and carbon taxes, I mean, I think I only started to see CFOs start to pay any attention to the climate agenda once a price was put on carbon. Until that point, it was really just about reporting greenhouse gases in sustainability reports. And I think there was even more lip service paid then, to be honest, Michael. So I think now we're in a saying, how do we stimulate, how do we accelerate climate change? Okay, and I get there's a potential unfairness between developed and developing countries, but the reality is something has to be done. So I think developing countries in the global south and South Africa has got a choice. Okay, so we can say, right, we can say we've been unfairly treated, or potentially we can sit down and say, right, okay, have we got an opportunity here, okay, to leapfrog, to be more competitive, to play smart, to use this green finance, to use carbon credits to accelerate our decarbonisation and potentially have sectors which are now globally competitive and got lower carbon footprints, but leveraging off all these instruments. And there's lots of them. And I think the discussions I have with many clients, even the really trade exposed ones, which in theory should be all over this, are not over it as much as they should be. Okay? There's been a couple of examples I'm working with globally where they've been, I suppose, impacted in other jurisdictions and they're on top of the issue. But generally, it's not embedded into the strategy of the organization.
Where do you see the opportunities? Green steel, for example, has got to be one where we could use our abundance of iron ore and then also use maybe green hydrogen, which is tied into some solar resource that we have. I mean, that seems to me to be a prime example.
I mean, you just look at, I think the solar industry is a really good example around, obviously, you make it more accessible to the market, accessible for you and me to be going solar. The prices have come down globally. I remember in the early years, you could get carbon credits on solar projects. Okay, and the reason for that was because solar projects were too expensive to implement. Making of solar panels was expensive. Chinese really hadn't got into the industry. So you could then generate a carbon revenue stream of that carbon reduction solar project. Now, the technology is so freely available and so cheap, you can't get a carbon revenue stream, even though you are reducing your emissions. So I think technology is coming down, and it's crowded in finance into solar and wind. Over the last sort of 10 or 15 years, it's been amazing to see. It's now what we as a country do with that. Can we create local manufacturing value chains? We've probably all seen the stats of the increase in imported solar panels.
Yeah.
While we had obviously load shedding and stuff. Is that a missed opportunity? And are there other opportunities that business can grab with both hands? And South Africans are innovative. Michael, I've seen it time and time again. We're really innovative bunch.
Let's understand the potential impacts here of a EU CBAM on South Africa and what happens to our exports under this current proposal and what might happen if it's extended to cover all goods and services and all direct and indirect emissions from upstream value chains.
Yes. So currently, as CBAM is currently legislated, it's covering cement. That's not really going to impact us as South Africa and Africa very much. There's not too much cement export. It's too heavy. You've got iron and steel, big sector in South Africa, exporting some to Europe, quite a big export to Europe. You've got aluminium, a big trade exposed sector to Europe. You've got fertilizers. You've got electricity, which we obviously don't export to Europe, and hydrogen. Okay, so those are the sectors that are currently covered. Do we expect more sectors to be added? Things like probably the chemical sector, polymer sector, we do expect those to be pretty added, and probably some announcements probably in 2026 on those. But we are starting to see other countries. So a good example now is the UK. Obviously, since Brexit, obviously they now need to design their own CBAM, and they've announced what they're going to cover. They've actually added 2 sectors. They've taken off the electricity, but they've added in glass and ceramic. Okay, so if you in any of those sectors, you need to understand, okay, so what do I currently export to Europe, the UK, or any other jurisdiction that's going to be implementing CBAM? Do I understand the impact with these phase-ins, the current embedded emissions in my product? Okay, and most companies, to be honest, will not have a clue. So you need to go on a knowledge journey, understanding your embedded emissions, doing some financial calculations. Okay, so how will it impact my product pricing, and then start to put a strategy in place. Am I going to potentially be blocked out of that market? Do I need to be looking at other markets? And we started to see that happen already, where some jurisdictions are going to struggle to implement a CBAM type instrument because they don't have a local carbon pricing mechanism currently in place. So their journey is going to be longer than Europe and UK is going to be.
And I mean, it is a significant study in potential impacts. If you look at the Reserve Bank paper, in terms of percentage deviation from the baseline, the chemical sector under the first scenario that they modeled, which is the current EU CBAM proposal, exports down 9%. If you go to the second scenario, which is an expanded proposal, down 54%. Iron and steel, 31% reduction down to 58%. And aluminium, 16% to 63%. These are huge numbers here. I'd note that outgoing Trade, Industry and Competition Minister Ibrahim Patel has said that South Africa is considering lodging a formal complaint at the WTO against what he calls the EU's protectionist carbon border tariff. If all other avenues fail, he added, how likely is a successful outcome, given that not only the EU seem to be pressing ahead with this, but now other jurisdictions as well, the likes of the US and Japan and others?
I mean, from my understanding of all the WTO rules, let's not underestimate the EU, right? Okay, I mean, they would have done lots of research. I mean, even way back in 2010, 2012, I was seeing papers on the WTO friendliness of any kind of carbon border adjustment and its environmental exemption. I think it's probably unlikely to be successful. And if it is going to be successful, I think it's going to take a really long time, to be successful. So is it going to be successful by 2026? 2027? The answer is no. And even reading some of these, I think, economic reports and studies that are put out, I mean, sometimes they assume that business is going to do nothing. They're going to sit on their hands and wait to be hit by the CBAM. And that's just not true. Okay, it's just not true. Businesses are looking at alternative strategies, alternative energy sources, how can they reduce their emissions in their production processes. I think there's lots of innovation happening, and that's what these, I suppose, instruments are meant to stimulate. So I would find it very surprising that some of those numbers and drops in exports to Europe actually manifest.
From a policy perspective, what should we be doing as a government? What policy measures should South Africa implement to position itself more as a green production destination and to reduce its exposure to CBAMs rather than running off to the WTO and fighting what seems to be a bit of a losing battle?
So I think generally you've got, I suppose, three main instruments to think about. So you've got regulation. So, okay, should we be putting more regulation in place? Not taxing or putting an incentive, put a regulation in place so people accelerate and pollute less. Okay, so there's clear, I suppose, certainty to business and give them timelines to amend their other production facilities. Secondly, we need to be thinking about, okay, incentives. And we started to see that, I think, really strongly in certain sectors. So let's take the automotive sector. It's clear the world is moving to electric vehicles or new energy vehicles over time. Yeah, maybe the timing of that is debatable, but the world is moving. And so South Africa is now saying, well, we're going to give OEMs additional 150% tax allowance on their manufacturing assets if they're going to make them. So again, you'll find more and more of the incentive regimes and even tax regimes start to have a specific focus on greenhouse gas reductions and climate change across sectors. Okay, so I think what sectors need to be doing, and whether they get embedded in master plans or not, need to be talking to government. How can government create some kind of incentive regime to accelerate? And then the final one is, I suppose, a tax, right? So the big question is, and the big uncertainty in the South African carbon tax environment currently is the phase out of those allowances, those free allowances. Currently, it is really important that government starts to give some signals and put out its policy papers and what it's thinking about the phase out of those allowances, because that's the effective carbon tax rate you pay. You don't pay at a gross rate, you pay at a net rate. So if business does not know, like Europe has now up to 2034 announced how they're going to phase in CBAM and phase out the allowances. In South Africa, we don't know what's going to happen with our allowances. So it's really important that business gets much more certainty around the phase out of those allowances from carbon tax. And otherwise, business doesn't know how it's going to get hit and can't plan accordingly.
Yeah, can't model. Just one last question for South Africa's banks. Obviously, they are engaged in this area of green finance more than I've ever seen them. It was certainly one of the poll questions at the conference was, what do you see as the big opportunities over the course of the next few years? And green finance was certainly up there, so it's on the radar screen. How should banks be approaching this? Should they be approaching the exposed clients to have this conversation with them, see how exposed they are to potential losses through a CBAM in their books? How would you be advising the big banks to approach this?
I think big banks need to start to really understand, I suppose, what they call their financed emissions. So they're obviously financing lots of carbon intensive businesses. So one is they need to make sure that they engage with them, make sure they understand what's happening globally in South Africa, but also globally. This has become a global conversation, and I spend a lot of my time tracking what's happening globally on carbon taxes, and there's just so many of them, and they're happening at every jurisdiction across Africa, across South America, Europe, Asia, and most of our businesses are trade exposed in one form or another. So they need to understand and put a process in place to track all these developments so they can understand, because what you don't want is you don't want stranded assets, right? You don't want assets which have to get written down because they can't make the product they were designed to make because they're too carbon intensive.
Fascinating. We're going to have to leave it there. Duane Newman, thank you very much, sharing all things CBAM here on the Monocle Banking Podcast, partner at EY Advisory. If you look at that Reserve Bank report at a headline level, under a severe scenario, our growth could be 9.3% less in 2050 if we don't respond. And clearly, businesses will respond, but we need greater certainty on certain issues, as Duane mentioned. Before we go, just a reminder that you can find us on all good podcast platforms. If you want to connect, reach out to me at Badger on Twitter or X, and email the team at Monocle Solutions. Thanks for tuning in, and until next time, don't forget to subscribe to the Monocle Banking Podcast.